The Federal Reserve, often called the Fed, is the central bank of the United States and one of the most influential forces in the economy. Its decisions shape financial markets, influence consumer behavior, and impact businesses. A central goal of the Fed is to keep inflation around 2%, which helps maintain stable prices and supports economic growth. It also aims to promote employment levels, creating a balanced environment for both businesses and households. The Fed's choices, especially about interest rates, can affect everyday spending and global financial markets. Adjusting interest rates is one of the main tools the Fed uses to guide the economy. These changes impact borrowing, saving, investing, and overall economic growth. When interest rates rise, borrowing becomes more expensive, which often slows spending and helps reduce inflation. This video focuses on how rising interest rates shape different parts of the economy. Understanding these effects offers valuable insights into how the Fed manages economic challenges and leads the nation toward stability and growth. Check out the full details by visiting the link in the description. Interest rates and their significance. Interest rates are the price paid to borrow money or the return earned on savings, expressed as a percentage. They influence financial decisions on a personal, corporate, and national level. A loan comes with a cost, as lenders charge interest in return for providing funds. Similarly, savings accounts offer interest as a reward for keeping money in a bank. These rates affect how people and businesses spend, save, and plan for the future. There are two main categories of interest rates. Nominal interest rates reflect the stated rate without considering inflation. Real interest rates adjust for inflation, showing the actual cost of borrowing or the real return on savings. This distinction highlights how inflation affects the value of money, which is why real interest rates provide a more accurate picture of economic costs and benefits. Interest rates play a crucial role in driving economic activity. When rates are low, borrowing becomes easier, which can encourage spending and investment. Higher rates, on the other hand, increase borrowing costs and tend to slow economic growth. In the following section, we will look at how these rate changes impact borrowing, consumer spending, and inflation. Number 1. Impact on borrowing costs. When the Federal Reserve raises interest rates, borrowing becomes more expensive for individuals and businesses alike. Loans for homes, cars, education, and business operations all come with higher monthly payments. According to the Committee for a Responsible Federal Budget, a 0.5% increase in the Federal Reserve's interest rate could add $1 trillion to the national deficit over the next decade due to the rising cost of government borrowing. For consumers and businesses, these higher expenses limit financial flexibility, reducing the likelihood of taking on new debt and slowing economic activity. Number 2. Consumer spending reduction. Higher interest rates often lead to reduced spending as borrowing costs climb. For instance, credit cards and personal loans become more expensive, causing people to cut back on purchases that they might otherwise make. Recent research shows that a 1% increase in interest rates can lead to a 0.5% decrease in consumer spending. This reduction slows economic growth, particularly in industries like retail and services that rely heavily on consumer purchases. Number 3. Effects on inflation. One of the primary reasons the Federal Reserve raises interest rates is to control inflation. When inflation surged to over 9% in June 2022, the highest in 4 decades, the Fed implemented rate hikes to stabilize prices. Higher interest rates discourage borrowing and spending, reducing demand for goods and services. While this can help lower inflation over time, it also means slower economic growth as businesses adjust to decreased consumer activity. Number 4. On our list of ways that Fed interest rate hikes could affect your finances is stock market volatility. Changes in interest rates often lead to swings in stock prices. Markets tend to react negatively to rate hikes, as higher borrowing costs can reduce corporate profits and make investors wary. Historical data shows that stock markets typically experience a decline in the months following a rate increase. This response highlights how sensitive markets are to shifts in monetary policy, with both businesses and investors needing to adjust to the new conditions. Number 5. Impact on savings accounts. On the positive side, rising interest rates can benefit people who save money. When interest rates go up, Banks usually increase the interest rates on savings accounts. This means that savers earn more on their deposits, helping their savings grow faster over time. This can be especially helpful for long-term savings goals, like saving for retirement or buying a home. While this rewards those who save, the benefit may be offset by higher costs in other areas, like loans or everyday expenses. Number 6. Real estate market slowdown. Higher mortgage rates are a common consequence of rising interest rates. Recent data suggests that an increase in mortgage rates from 3% to 7% could raise monthly payments by over $1,200 for a $500,000 mortgage, depending on the exact terms and duration of the loan. This dramatic rise reduces the number of people able to afford a home, leading to a slowdown in home sales and construction. As a result, the housing market often sees reduced activity when interest rates rise. Number 7. Corporate borrowing costs. Businesses also feel the impact of higher interest rates. Loans for financing operations, expansions, or investments become more expensive, reducing profitability. While banks may benefit from higher loan interest earnings, other sectors face challenges. Companies may postpone expansion plans or cut costs, including hiring freezes or layoffs, to adjust to the new financial reality. This can have a ripple effect on the broader economy as businesses scale back their activities. Number 8 on our list of ways that Fed interest rate hikes could affect your finances is job market effects. Higher interest rates can lead to slower job growth or even increased unemployment. As businesses face rising costs for loans and reduced consumer spending, they may limit hiring or reduce their workforce to maintain profitability. Over time, these adjustments can create challenges for workers, particularly in sectors heavily reliant on consumer activity or expansion-driven jobs. Number 9. Consumer confidence decline. Rising interest rates often hurt consumer confidence. As borrowing costs increase, households may feel uncertain about their financial stability. Higher credit card rates and larger loan payments can lead people to delay purchases, especially for big-ticket items. A 2023 study shows that when interest rates are expected to rise, consumers may postpone purchases for several months. This is particularly noticeable in the housing and automotive markets, where higher loan costs can significantly affect affordability and decision-making. Before we continue with the video, take a quick moment to hit that like button and subscribe if you haven't yet. And don't forget to ring the bell for notifications so you never miss out on our latest updates. Plus, we've got some helpful resources in the description. Check them out and share your comments after you're done watching. Number 10. Impact on national debt. Rising interest rates not only affect consumers and businesses, but also have a significant impact on government finances. As borrowing costs increase, the government faces higher expenses for servicing its debt. The Congressional Budget Office projects that annual net interest costs will total $892 billion in 2024, potentially reaching $1.7 trillion by 2034 due to the higher interest rates applied to government debt. These growing costs can strain federal budgets, limiting the ability to invest in other priorities and potentially widening budget deficits over time. Number 11. Effects on international markets. When the Federal Reserve raises interest rates, the impact often extends beyond U.S. borders. Higher rates can draw capital into U.S. markets as investors seek better returns, leading to capital outflows from emerging economies. This shift can weaken the currencies of these nations, increase borrowing costs in global markets, and create financial instability in vulnerable economies. As a result, international markets often experience greater volatility during periods of U.S. rate hikes. Number 12 on our list of ways that Fed interest rate hikes could affect your finances is changes in investment strategies. Higher interest rates often lead investors to adjust their portfolios. Safer options, such as bonds, become more attractive because they offer better returns compared to riskier assets like stocks. This shift in preference can lower stock market activity and increase demand for fixed income investments. Over time, these changes may lead to more cautious investment approaches as investors respond to higher borrowing costs and slower economic growth. Number 13. Increased credit card costs. Credit card interest rates typically rise when the Federal Reserve increases its benchmark rates. As a result, carrying a balance on a credit card becomes more expensive, leaving consumers paying more in interest on their existing debt. This encourages some people to reduce their credit usage or pay down balances more aggressively, while others may struggle to manage their payments. The financial strain caused by these higher rates can affect spending habits and overall financial well-being. Number 14. Business expansion constraints. When borrowing becomes more costly, businesses often scale back their plans for growth. Higher interest rates mean that loans for expansions, equipment purchases, or other projects require larger repayments, which can reduce profitability. Many companies delay or cancel investment plans, limiting their ability to grow. This cautious approach can slow overall economic progress, particularly in industries that rely heavily on financing. Number 15. Potential for recession. A sharp rise in interest rates can sometimes push the economy into a recession. A recent study reviewed 16 instances since 1950 when central banks raised borrowing costs to combat inflation. In every case, the result was an economic downturn. Rate hikes can reduce demand across various sectors, putting pressure on businesses and leading to layoffs or closures. This historical trend highlights the delicate balance the Federal Reserve must maintain to manage inflation without stifling economic growth entirely. Number 16 on our list of ways that Fed interest rate hikes could affect your finances is effects on life insurance policies. Rising interest rates can also influence life insurance policies, particularly those with investment components. Policies that offer cash value or dividends may see changes in their returns as insurers adjust their investments to reflect higher rates. While this can improve returns for policyholders in some cases, it may also shift the cost structures of new policies. Consumers should carefully review their policies during periods of rate changes to understand how their benefits might be affected. Number 17. Long-term economic growth implications. Sustained periods of high interest rates can slow long-term economic growth. Higher borrowing costs discourage investment and reduce spending, which can limit gains in productivity, innovation, and job creation over time. While controlling inflation is crucial, prolonged restrictive policies can lead to lower levels of economic output and growth, making it important to balance rate increases with efforts to support broader economic health. Number 18. Psychological effects on consumers and businesses. The expectation of rising interest rates can influence behavior even before the changes take effect. Anticipation of higher costs may lead consumers to hold off on purchases, particularly for expensive items such as homes or cars. Businesses may also delay hiring or investment decisions if they foresee higher costs of financing. These shifts in behavior reflect the significant role that expectations play in shaping economic activity during periods of monetary policy adjustments. Last on our list of ways that Fed interest rate hikes could affect your finances is policy responses from other central banks. When the Federal Reserve raises interest rates, other central banks often respond with adjustments of their own. Some may raise their rates to prevent capital outflows and maintain currency stability. Others might take different approaches depending on their economic conditions. These responses highlight the interconnectedness of global monetary systems and the ripple effects of the Federal Reserve's decisions on the broader international economy. Rising interest rates set by the Federal Reserve have widespread effects on everyday expenses and the economy. Higher rates increase borrowing costs for individuals and businesses, which can influence how people spend and invest their money. While higher rates can help control inflation and benefit savers, they also create challenges, such as slowing job growth and increasing the national debt. Recognizing these effects helps explain the Fed's efforts to maintain economic stability. Understanding these impacts gives a clearer view of how monetary policy affects financial decisions, household budgets, and everyday expenses in the overall economy. Thanks for watching, and if you found this video helpful, don't forget to like, subscribe, and share it with your friends. Also, don't forget the link in the description.